For more on the administration's affordability push in the markets, let's bring in Mike Schumacher, head of macro strategy at Wells Fargo Securities. Mike, great to see you here on set. This whole theme of affordability, it's sort of the through line right now in terms of the actions from the Trump administration in recent days. Do you think does that impact your view of the markets about, the robustness of consumer spending, of corporations' confidence, anything like that?
It helps a little bit on the margin, but it's not a massive impact as far as broad macro markets. But I do think it's a good point when you think about the mortgage market, the housing market, it's segmented. And it's all well and good to talk about people having mortgage rates at sub-3, but think about people who took out those loans. They're probably 40 to 50. So think about the new buyers, new borrowers who are 30, 35. It helps them. So it helps them a bit, helps politically. Does it really drive Treasury yields? Not too much, but still, I think on the margin, it helps a little bit.
But on top of this, there's also stimulus. There could be stimulus checks coming to Americans, but certainly there's going to be tax refunds. And that should all help. Does that inform your view of the markets?
It does. And that was baked into the One Big Beautiful Bill. So that's actually coming online now with tax refunds or really lower tax payments. That's going to happen pretty clearly. What is interesting, though, in addition to that, so that's pretty well understood, I think, but you also have to factor in it's an election year now. It seems like it always is in the U.S., but now it's getting real. Is Congress really going to spend a lot more money? No. So you get this one big burst of stimulus coming up for the next 3 to 4 months. Then it's probably kind of a desert for the next year or so. So I think unless there's a massive downturn, Congress will not step in to help out.
Mike, so the dynamic with the Fed, you think they're kind of on hold here, or articulate what you think the view is, and the Fed relative to other central banks around the world and what that means. Also, just kind of dollar dynamics, rate dynamics here, because I get the sense that the stock market is pretty jazzed up by the prospect of somewhat lower rates, somewhat weaker dollar, and that's a great environment for equities.
Yeah, really, that's basically our core view right now, Tim, is the Fed would like to cut a couple more times, but it doesn't have to be now. Is it going to be this month? I'd be shocked. The market's pricing less than a 5% chance of a rate cut now. It was probably 10 to 15% a couple days ago, so the market said, no, not going to happen now. Could they go in March? Could they go a bit later in the year? Yes, I think that's right, but they need to see some data that's actually clean. The data this morning was anything but total mess. CPI is going to be messy as well. What do you make out of that?
What do you mean by messy?
Well, you had jobs actually that were down relative to expectations.
So not good.
Unemployment relatively good. So whatever you wanted to think about that, you could take away from it. It didn't change anybody's view about anything. And CPI is probably the same deal. So I would say the Fed has to wait another month or two until it gets a pretty clean slate of data and it can say, yeah, I can actually look at this. I can pop it into my spreadsheet. I can do a nice chart here on CNBC, and I can see how the economy is actually evolving. But until we get another month or two out, there's really not much the Fed can do. So I think the Fed would like to cut, but not just yet. So whether it's 2 more times, 3 more times, not really sure. I think that's still pretty likely. Not a given, but that's our base case.
So if the Fed's sort of on hold, let's say, for the short term, is your view of the market positive because you think earnings will go up, multiples will go up, both? How do you think you get there?
Yeah, as far as the equity market goes, I'll defer to my colleague Osung. He's bullish basically for an earnings call. That's really his main rationale. But if you think about the overall environment, the story really Tim just painted, it sounds okay for risk. We were on a call yesterday talking about volatility, which I think is a pretty good indicator. And if you think about market after market, volatilities are really low. So just think about implied volatility as the price of insurance. The VIX is super low. Foreign exchange volatility is really low, down to less than 10th percentile in most currencies. Interest rate volatility was kind of a laggard. It's crashed down over the last few months. What that tells me is investors are saying we're pretty comfortable. Are they overconfident? Maybe, but probably not quite yet. But still, I think it's telling us that people are pretty sanguine about taking risk right now. They're taking more of it as far as I can tell, Karen.